What's up, everyone? Welcome to the daily macro update for Tuesday, December 30th. This will be the last daily macro update of 2025, and we're going to be getting into the three 2026 market predictions that my team and I have thought about based off of the current macro data that we're getting, as well as the trajectory of the markets as we see it right now. And so we're going to go ahead and get into all the different news that we got today. Really a quiet week with the holiday week being New Year's on Thursday, New Year's Eve tomorrow. And so we'll be getting into a lot of that. But if you guys appreciate this macro content, consider subscribing on our YouTube page, as well as share this with any friends or family members that you think would enjoy this content. I know that we were supposed to start at 3:45. We're about 10 minutes late, so I appreciate your all patience. Just running a little bit behind here, but let's go ahead and get right into it here with the FOMC press conference minutes from the December meeting came out today. And really, it was more of the same of what we already had heard, but it's important to take a look at any type of different things that may be different or just a reiteration of what they're talking about. But really, in conclusion, we're in this new Fed regime, right, where we went from plenty of reserves, right? So in terms of bank reserves, right, we went from just more reserves that the market can handle now down to ample reserves, right, from the 2 years of quantitative tightening. And so essentially what they suggested, right, if we wanted to look at a summary, they are cutting interest rates to support the labor market while simultaneously expanding their balance sheet by buying treasury bills in order to support the financial plumbing that's going on right now, essentially bending the knee to what the government is doing, which is borrowing from the short end of the curve, borrowing by issuing treasury bills because rates are a lot higher than they would like it to be. So essentially, the Fed is saying that they are trying to support the government's insane deficit problem in the hopes that they'll cut interest rates, but they're the ones that are controlling it, and at least the short end of the curve. But this is causing an issue right now, and this is something that we've seen in history as well, which is when the central bankers start to bend the knee to governments, then we get into this out of control inflationary type of environment. And the only way out of this, and this is what the government as well as what the Fed is betting on, is this what's called immaculate acceleration. And this is the thesis that relies on the belief that the recent tariff driven inflation is transitory, right? So they're basically saying inflation is transitory yet again, and that the labor market cracks are the more imminent threat, and that the AI boom is going to essentially bail out a lot of the issues that we're currently experiencing right now with this no landing type of scenario. So they're hoping that the AI boom is going to help us grow out of this issue, and it'll then support them to then do what they always do, which is inflate the debt away, And ultimately, this is going to lead to higher equity prices, and we're already starting to see signals of this, fiscal dominance type of environment with things like silver, as well as platinum and palladium. All these different industrial as well as precious metals just go absolutely parabolic over the last few trading days, which I'm sure you've seen on the news because that is now what's being talked about all over the place, right? So, just getting into some of the details here. The overview is that the December minutes revealed that the Federal Reserve has pivoted from passive observation to active intervention in liquidity markets while also delivering a contested interest rate cut. The committee voted to lower the Fed funds rate by 25 basis points to a target range of 3.5 to 3.75%. However, the decision highlighted a deepening fracture within the committee, with three members dissenting against the majority. So, this was a critical shift. They're calling this a liquidity pivot, right? So, they're going from quantitative tightening to now they're doing bond purchases, which is a form of quantitative easing, but isn't quantitative easing in the classical sense, where they bombard the market with just massive purchases of long duration bonds. They are doing strategically small to medium size, and they're adjusting it based on the month purchases of treasury bills in order to support the government's debt issue. Okay. And so um this is the most meaningful change in the minutes that we've seen over the past few years, and this is a formal acknowledgement that bank reserves have fallen to the ample level, necessitating immediate balance sheet expansion to prevent a liquidity crunch. What's interesting is that when you take a look at the price of Bitcoin, it's saying that these risks are starting to grow. And yeah, I mean, with the market making all time highs, but Bitcoin not making all time highs, this is a very important thing to consider for what's going to come the next year, which we'll get into momentarily with our three different scenarios for the 2026 prediction. And so, just getting into the details of this, the committee agreed to initiate reserve management purchases (RMPs) starting in December. The desk will purchase treasury bills, which is short-term debt, to increase the system open market account holdings, or SOMA. The rationale is that this is designed to offset a projected steep decline in reserves in April uh, in 2026 due to tax inflows of the Treasury General Account, right? And so the committee voted to remove the $500 billion aggregate daily limit on standing repo operations to ensure interest rate control. That's them basically saying they're doing a slightly different variation of Japanese yield curve control, controlling the short end of the curve. And policymakers emphasize that these purchases are for market function interest rate control specifically and do not signal a change in the stance of monetary policy, even though that's what they're doing. It's a different form of quantitative easing. And the reason why they're doing this is because the consensus has shifted toward protecting the labor market despite elevated inflation data. So, just a synopsis of that. The labor market downside risks to employment have risen in recent months. The unemployment rate ticked up to 4.4% in September, and payroll gains have slowed. Headline and core PCE inflation remained elevated at 2.8%, and participants noted that while core good prices rose due to tariffs, housing services inflation continued to cool, which is actually true. And that they essentially blamed the entire inflation acceleration, or the sticky inflation, 100% on tariffs. And so many of the Fed participants judged that the effects of tariffs on inflation would wane, and the risk of them causing persistent inflation has diminished, meaning that they're going back to the 2021 inflation is transitory type of consensus, which didn't work out for them last time, but we'll see if things will change this time. And then the big thing also, too, was the fractured dissents, right? So normally, whenever they vote, right, there's 12 people on the committee. Normally, you might have one person that dissents, but the majority of the time, you have 12 out of 12 voting the same way. And so in this one, you actually had a 9-3 vote, cutting versus pausing, which signaled a significant internal disagreement regarding the neutral rate, right? So the majority, 9 votes, supported the 25 basis point cut because of the employment downside risks. And there was 2 dissents that preferred no change, so keeping rates where they were at, arguing that inflation has stalled and that could produce longer inflation risks. And then there was one person that preferred a 50 basis point cut. So that's pretty interesting there. Despite all this, their summary of economic projections stated that they project that real GDP growth will start to speed up in 2026, which is being supported by financial market conditions and potential AI-driven productivity gains. And then a lot of the market participants in the FOMC expect approximately 2 more cuts by the end of next year, right? This is different from the 4 cuts just a couple months ago. So that technically has been a reduction in the amount of cuts if we're just looking at the futures market, as well as the confirmation from the Fed, meaning that you might get down to a 3.0 to 3.25% neutral rate, and then they would just keep it steady from there and not cut anymore. And so the committee reiterated that the policy is not on a preset course, but the initiation of RMPs confirms that the Fed is now actively managing the floor of the liquidity system to prevent volatility. Now, historically, they have not done a good job of that. So we'll see what happens from here. But there is no doubt that we are in this later stage of the business cycle. And if they are trying to control volatility, they are then suggesting that there is a risk of elevated volatility, which we could see happen. So that's pretty much the summary of the FOMC minutes here. We did also get some other, macro data. Nothing too crazy though. Nothing that I really saw that was out of the ordinary there. It was really just the Fed highlights. Before we get into the 3 different scenarios, just taking a look at the market here, it did close about 6 minutes ago. The market was slightly down, pretty much, neutral. Tomorrow, the last day of the year, December 31st, the last trading day of the year as well. We'll see what happens, but yeah, you still have one more day to take advantage of any tax loss harvesting. But we'll see what happens from here. Volume still remains incredibly low. I mean, this is such a bearish divergence. I don't even know what to say. I mean, if you're not taking profits right now, then I really don't know what you're doing. So yeah, it's all going to depend on when volume actually comes back on January 5th, next Monday. And so yeah, I mean, even after the new year, we still have Friday, which is another active trading day. That is technically the first trading day of 2025. Obviously, the first is closed for the holiday there. It's interesting because rates are still remaining higher despite them cutting back in September. Interest rates are essentially 10 basis points above where they were at when they cutted. So if anything, interest rates have actually gone up since they started cutting in September, similar to what we saw back in 2024. And but we are still getting inflation expectations coming down on the break evens there. So I do think that we could continue to enter a period where we get some disinflation. The problem is that this might be due to actual productivity declining instead of the productivity boom that they are putting a huge bet on. A lot of the different things that were having a correction yesterday, like platinum, silver, are now having a bounce today, back up to the top end of the trading range. So again, another day to sell some more. This has been the hype crowded trade of December. And yeah, I mean, if you're buying silver here at the top end of the trading range, that would be going against our process. So, but you can do what you want there. Bitcoin up slightly, but it's pretty much gone sideways. Year to date, Bitcoin is down about 5%, which is, something that a lot of people were not predicting. But, this is in and of itself a macro signal because Bitcoin is a highly liquidity sensitive asset. And with the whole thing from the Fed today being that, they're having to start to intervene a little bit due to liquidity concerns, Bitcoin is actually a real price confirmation of that, which, I think that is the biggest threat heading into next year, which we'll get into with the four different scenarios momentarily here. But yeah, um, in terms of the Mag 7 stocks, Meta looks like it could be having a little bit of a run here. Ominous close with the price of $666, but still have another trading date tomorrow. Tesla giving a little bit of an opportunity at the lower of the trading range. This remains in bullish trend. I might buy some of that on the open tomorrow, actually. Energy looks like it's continuing its bullish trend. Communications, utilities and XLRE, real estate still remain in bearish trend. Might end up pressing some shorts on those. Everything else looks pretty bullish except for consumer staples. Might buy some financials. But yeah, that's what that looks like there. So yeah, that's pretty much what I'm seeing in the markets. Volatility remains relatively low. I mean, we're approaching record low levels heading into the new year. So great time to raise some cash, sell some things, and get prepared for any opportunities coming up. But with that, what we'll do is we'll get into some of the different price predictions here, and or not price predictions, but macro predictions for 2026. And really, we're looking at a chart right now of our trading range or our yield curve phase signal indicator in TradingView, which is available to everybody. If you just look me up on TradingView, it's included as something that you can access yourself. So that's there. But let's go ahead and get into the three different scenarios here. So this is all based off of my team's yield curve phase signal model, which is something that we use. The bond market is considered smart money. So you want to basically be taking a look at the different transition phases as well as what it's done historically in order to, get a gauge on what it's pricing in, So you can't just use the bond market itself. You have to compare it to what the currency market is doing, precious metals, Bitcoin, cryptocurrency markets, as well as, what the real data is suggesting and try and notice any type of divergences there. But I'm going to have this chart up because right now the yield curve is still in a bull steepening cycle, meaning that shorter term rates are coming down, but we're also seeing an increase in the longer duration yields, meaning that at the same time as the short end is coming down, the long end is going up, which is something that is very highly unusual and typically only happens when you get into this fiscal dominance type of environment. And so, as of today, the yield curve is doing what's called a bull steepening. And so, seeing this as well as the trend also turning into a bear steepener, the Fed is essentially cutting interest rates to support the government's deficit spending, which could cause potentially an increase in inflation later on in the year. And so let's just get into this transition here, going from a bull steepening to a bear steepener. And so you guys can research this on your own, but this essentially is the soft landing or no landing scenario where fiscal spending prevents a deep recession, but on the other end of that, it also reignites inflation, right? And so right now we're currently in this bull steepening phase where the Fed is easing as 2026 begins. This is where the stimulus could really take hold, and we go from more of a tariff-driven inflation to a more fiscal deficit driven inflation, right? And so the focus shifts from Fed cutting rates to market pricing in future growth and inflation, which is kind of what we're seeing with the 10-year rising, right? And so this is what's called a stimulus fueled economy. This lifts inflation expectations, which would mean that the Fed might have to start either really dialing back, like pausing from here and not getting down to their projected neutral rate. Or worst case scenario, another 2022 happens where they actually have to maybe increase rates a little bit, which I don't see that happening. But they essentially could just raise their neutral rate, meaning that instead of doing two cuts next year, they only do one. And if inflation really takes hold, that's where you're going to get a huge market sell off. But that's not our base case. Our base case is that liquidity starts to come back and growth fears essentially vanish, right? And even though you get persistently higher inflation, it'll tick down slowly, right? And so in this scenario, you want to be short bonds, you want to be long equities, kind of like what's been happening right now. And then what you want to do is, in order to confirm that happen, you want to see Bitcoin start to actually regain strength, which we are seeing a little bit of positive developments with Bitcoin, but that's really the main indicator that you want to look at. Now, scenario two is the not good case, right? So this is what we're calling a inflation whiplash. And this is where the market realizes that the Fed made another policy error similar to 2022. So fiscal dominance, this is a scenario where fiscal dominance starts to really consume the narrative, as well as inflation going higher, while there's no more no more new tariffs, right? So all of the Fed narrative right now, which is blaming the inflation on tariffs, if we start to get those services inflation and housing inflation start to go up again, or even remaining steady, or even going up again, then that would actually cause a huge panic in the markets. So um, you want to be paying attention to how fast and how much of a magnitude the 10-year yield starts to rise, because if that ends up really going up from here, then man, that's really not going to be good news, right? So um, this is where this bull steepening effect in the yield curve works too well. Inflation reignites in early 2026, and the Fed is forced to end their stimulus early, meaning they stop doing QE, and they might even start talking about rate hikes. This is where the 2-year yield starts to end up actually going up from here. So right now, the 2-year yield is in a bearish trend. This is where it would flip to more a bullish trend. And then the yield curve ends up reflattening into what's called a bear flatten, which is similar to what we saw back here from May to August of 2025. And that was when, you really had not the best time in the markets, right? So that would be the second case, still not the base case. Now, this would be bearish for most assets, right? Stocks would drop, bonds would also drop, and crypto might rebound initially on that bull steepener, but then it would also have a drop, right? So it would be like a little bit of a head fake in early 2026. And then if we see yields continue higher, that together, right? So you get that bear steepening into a bear flattening. That would be something similar that we saw at the end of 2021 and into 2022, right? So yeah, and then the third scenario is called the liquidity trap. Now, in this scenario, fiscal dominance fails to offset the weight of new debt, of all the debt that's going on, and the sugar high of the markets, and this government spending ends up wearing off, and then the private economy ends up going down, right? In other words, this is where you get some type of 2020 as well as 2008 crash, and so yeah, that would not be a good scenario at all for all markets. And this is where you get a large acceleration, or I'm sorry, a large deceleration in both the 10-year and the 2-year yield. Now, that would get inflation under control, but that's where you enter into a recession. And in order to solve that crisis, the Fed would have to go into full-blown quantitative easing, where you don't want to be, as the Fed is doing that and there's panic ensuing, you don't want to be holding these types of risk on assets. But then after the dust has settled, that is where you would like to buy, right? And so Yeah, I mean, the macro trigger for that could be a number of things, right? That's kind of like trying to predict the credit event. It's really hard to do that, but this is where the growth productivity ends up being completely wrong compared to the Fed's current summary of economic projections. Both the 2-year and the 10-year yield end up dropping fast together. And yeah, this could be falling into like a 2008 type of crash. Now that's not the base case. The base case right now is that we just continue on into this environment where liquidity is still tight, but you really need to pay attention to specific asset classes in order to outpace the market, right? And that's kind of what we got this year. The market did well, but things like Bitcoin, you couldn't just be invested in all risk on assets, essentially. Like you had to be very strategic on which ones to be invested in. And so that's what we will most likely see. But yeah, if we were heading into scenario three, which is that liquidity trap, which is where the 10-year yield would be falling alongside the 2-year, then yeah, that might even be an early sign that the market is sniffing out that fiscal re-inflation, you know? So you definitely want to be taking a look at what the 10-year and the 2-year are doing from here. But yeah, at that point you would just rotate into defensive and bonds at that point. But yeah, um summarize here, our base case is a fiscal reflation, which is where things kind of tread along. You get a little bit of stickier inflation, but then it ends up coming back down to the 2% goal, um, over the next couple years. And you just have to be very strategic on which assets you're getting into, and not just a blanket, throw a dart at all the things risk asset wise. The other case is the inflation whiplash, where that could be a pretty volatile market. This is where the market calls out a policy error of the Fed. And then the last is the liquidity trap. And this is where liquidity ends up becoming materially a larger problem. And we get a 2020, 2008 style crash. So that I think that's the least likely to happen, but we'll see. We'll see what happens from here. It really just depends on the first 3 months of the year to see what happens. Typically, if we're just looking at seasonality, um, you typically see a little bit of a market drawdown in the winter months, and then it starts to come back during spring, right? And then the summer months are typically good months seasonally. But then also as well, noticing that next year is a midterm year, going all the way back to 1962. Midterm years have averaged negative 2% on the year for the S&P 500, which obviously, it can have years that are great. I think like during the Reagan years, there was like a 22% year during the midterms, but obviously we're not in that type of environment where people are looking at Trump like a Reagan 2.0. So, I think that we do have to be a little bit mindful of kind of that uncertainty that comes with midterm years, and just know that typically it has a poor performance on average, right? Compared to election years, which actually end up having better than expected returns. So, yeah, midterm years usually are the worst. But, we'll keep that in mind. And then, yeah, but those are our three scenarios. And it's not really something that is super concerning, but you have to be incredibly specific and incredibly strategic on where you're positioning, right? It's not just like a blanket, throw your money into risk on assets and AI and hope for the best. You have to be pretty surgical going into next year, which is, what we do here at Macro Optics. We're here to use our model to help point you to the different assets that are doing the best, given the macro environment. And then as that changes, we'll suggest other types of other things. And so, If you'd like to start the year off strong with learning macro, knowing what our model is actually pointing to in real time every single day, and you want to stay ahead of the curve, we still have one more day tomorrow to take advantage of our 6 week macro mastery challenge. Tomorrow's the last day. So, for those who want to take a look at that, you can just go to the link in the description below. Um, I'm not sure why it's not showing. I did open up some days tomorrow. I'm not sure why it's not showing that, but you can just send me a DM if you're interested in that. But tomorrow is the last day to enroll. But yeah, that's pretty much all I have for you all. We can get into some questions here in the last 5 minutes, and then we can call it a wrap. Again, no daily macro update tomorrow, but we will be back on Friday for the daily macro update. So, and then also on Sunday. Actually, you know what? No daily macro update on Friday. We'll be back on Sunday because that's going to be kind of like a nothing burger day. But we can go ahead and get into some questions here in the next 5 minutes. Let me know what you think about the three scenarios that we have there, and we can get into some questions. Let's see here. Thoughts on SPY APR 20 puts in the money for 690, a good hedge? I mean, why would you open up, puts on the S&P 500 when it's in a bullish trend? So, not sure why you would do that. As a hedge, I mean, you could if you wanted to, but the rule for us is that we never short things in bullish trend, even if they look like they're going to have a little bit of a pullback. It's a risky thing to do that. You mentioned that you thought that 2023 was close to being a recession. Are those indicators close to flashing? No, I mean, 2023 was actually a pretty large expansion year, um, a large recovery year. So no, I mean, I think 2023, it did initially fake me out because I was looking at a lot of those manufacturing numbers, but the aggregate for the economy never fell into recession. So I was definitely among those people who made that mistake. But the thing is that when you make a mistake, you recognize it early and then correct yourself. In terms of credit risks, what would be a good chart indicator for that? Just look at the 10-year. You can look at the 10-year yield, or I guess credit risk specifically. You can take a look at credit spreads, which it's this ticker right here. You can take a screenshot, kind of a long one. But yeah, and then as long as it stays, you know, not approaching or going above that 3.5 line, it should be good. Is your group on its own platform or is it on Discord? No, it's on a platform called Heartbeat. So Heartbeat is a little bit of a mixture between like Facebook and Discord. It's a lot more professional, and yeah, that's the preferred platform that we decided to go with. Good questions, though. Good questions. What does a fiscal policy really mean? Fiscal just means government. So whenever you see the word fiscal, just think it's government. So fiscal policy is government policy. What they're doing with taxes, what they're doing with spending, what they're doing with their debt, right? So in this case, right now, the fiscal policy, and we can go to, um, we can just go to Treasury issuance right here. Let's go to the last 10 years. So as you can see, I'm looking at bills, short duration bills versus long-term bonds, you can see that from July of 2023 to now, it's been an acceleration in um, bill issuance. So, what that means is that compared to the Biden years, there is absolutely zero difference between the fiscal policy that Biden was doing versus what Trump is doing. Trump is doing the exact same thing Biden was doing in terms of issuing short duration debt. But I guess if you're looking at the Treasury Secretary under each administration, Scott Bessent is doing the same thing that Janet Yellen was doing, right? Even though he ran on saying that that wasn't a smart idea. So he kind of ditched his critiques and just copied the same playbook that Janet Yellen was doing that he was crapping on. So that was interesting. Politicians lied, man. That's quite surprising, isn't it? But yeah, so there's really no difference in terms of fiscal policy and spending between the Biden admin versus Trump admin. So, yeah, good question though. Good question. But let's take a look at some of the chats from TikTok and then we'll go ahead and wrap it up. Just scrolling through. I do think inflation is cooling. The group is on Heartbeat. Thoughts on copper? Bullish. Is it too late to get into silver? I wouldn't be buying here. Okay, well, we'll go ahead and wrap it up there, everyone. I hope everyone has a safe new year. And we will be back here on Sunday's Sunday Macro Wrap Up, the first Sunday Macro Wrap Up of 2026. And yeah, I hope everyone has a fantastic and safe new year. Thanks again for a great year, everyone. This was definitely awesome time. And I can't wait to see what happens in 2026. So I appreciate everyone for, joining these live streams. I know I only have like usually a few people on here, but hope to grow the channels more. I'm definitely going to be rolling out a lot of content here coming up. I know I've kind of taken a little bit of a break on the short videos, but we'll be back full blown and we're going to have a great year. So I appreciate everyone for joining. And yeah, we will see you on Sunday's Sunday Macro Wrap Up. Bye, everyone.